Now that we have discussed which metrics you should use and when, the next question becomes how to know what is a fair price to pay for a stock. In this video, we are going to apply the knowledge we have gained from our previous videos to our discounted cash flow calculator here on Stock Analog. And I will show you how you can better understand if a business is under or overvalued. So the first thing that I actually like to do is head over to the stock that I want to run a discounted cash flow calculation on. And for our first example, we are going to be using Google. I go over to Stock Analog's freeform tool, and I put in the price ratio that I'm going to be projecting out and the metric that I'm going to be projecting out in the future. So for Google in this example, I want to use the operating cash flow and the price to operating cash flow metrics. And by using our freeform tool, we can see that over the past decade, Google has had an average price to operating cash flow of about 17.45, or about 17.5 if we want to round up. Now we can also see that the lowest that Google has traded for has been about a 12 price to operating cash flow, which is how the stock is trading today. By the way, I am recording this video in December of 2022. I think that this video will probably post sometime in early 2023, so the stock prices are not going to line up exactly as they do in this video. But yeah, that's what I like to do over in the freeform tool, and then I bring that little information that I gained over to the discounted cash flow calculator. So we are going to be using Google, and we are going to be tracking its operating cash flow and projecting out the numbers over the next decade, because I am a long-term investor and I plan on holding this business over the next 10 years. Now, also what our discounted cash flow calculator does is it auto fills in the metric when you input it. So for example, we can see here that I am using the operating cash flow, and over the past 10 years or the past decade, Google has grown its operating cash flow at an annual rate of about 19% a year. We can also see that over the past decade, Google on average has repurchased about 0.2% of its shares, and it's traded for about a 17 price to operating cash flow, which we already saw over in the freeform tool. Now, personally, I do not think that Google is going to grow its operating cash flow at 19% per year over the next decade. I essentially think that Google's operating cash flow growth is actually going to slow down. So I think that this is a little bit too optimistic. So I'm going to override the autofill metrics here and input my own. And what I like to do is see what the market is currently pricing Google at. So I'm going to lower this down to a 10% growth rate. And when we do, we can see that Google is still selling well below fair value right now, because the fair value gives us about $126. The current stock price is about $89, so it's about 42% under fair value. So let's knock this number down to about 8%, and we can see that Google is still selling below fair value. So I'm also going to knock down the price ratio to about 15, which I think Google will probably trade at in the future. So when I give Google a 15 price to operating cash flow and an 8% growth rate, it's still slightly above fair value. So let's do 7.5%, 7.6% right there. Now, I also think that Google is going to buy back about 1.5% of their shares going forward, because the company is focusing more of its cash flows on buying back shares, especially while the stock is cheap. So I actually think that the stock or the company could buy back more than 1.5% of its shares annually, and I think that this is a little bit more on the conservative end. So now let's knock down our growth rate to about 6.5%. And when we do this, we can see that Google's fair value now is about $90.55, or about 1.8% above where the stock is currently trading. So what this essentially tells me right here is that over the next decade, Google's current stock price is factoring in 6.5% annual operating cash flow growth, them to buy back 1.5% of their shares annually, and to trade at a 15 price to operating cash flow in the future. And if all of these metrics are hit, then Google will give us a compounded annual growth rate of 10.2% in the future. And again, the stock's fair value is at $91. Now, when we scroll down, we can see the actual growth to the metric that we inputted, which is the operating cash flow. And at a 6.5% annual growth rate to Google's operating cash flow, it means that by 2032, the company will be producing about $174 billion in operating cash flow. Now, in the last 12 months, Google has produced about $93 billion in operating cash flow. So this means that the company will not even double its operating cash flow over the next decade, which I actually think Google will do. So I think that these metrics right here, what the market is currently pricing Google at, is a little bit bearish. And that tells me that there is probably an opportunity here. Because for me, I think that Google could easily grow its operating cash flow at 8% over the next decade. And if the company also buys back 2% of its shares over the next decade, then it increases our fair value for the stock to about $110 a share, or about 23% above where the stock is currently trading. Also, if these metrics that I just entered are hit, then Google will give us a compounded annual growth rate of about 12.3% on the investment. Now, if we also scroll down, with an 8% growth rate to Google's operating cash flow over the next decade, it tells us that the company will be producing about $200 billion in annual operating cash flow by 2032, which I think is more realistic and probably where the company's actually going to hit. With the growth of YouTube and Google Cloud in India and everything like that, I definitely think that this is a little bit more conservative calculation. Now let's use another example here, which is Equitable Bank. And since we already went through which metrics we should use on which different industries, we know that for banks, we should be using the earnings to value them. So that is what we are going to do. Now we can see once again, since we just grabbed a new stock and a new metric, our discounted cash flow calculator is going to auto-fill these boxes right here. So the annual earnings growth for Equitable Bank over the previous decade has been 14%. It's diluted by about 1% annually, and it's traded for a price to earnings ratio of about 7.2. Now, if we project out the performance of Equitable Bank over the next decade, then it tells us that the fair value is about $75 a share, or about 31.7% above where the stock is currently trading. Now, I do not think that Equitable Bank is going to grow its earnings at 14% over the next decade, and I think that 10% is probably more optimistic or realistic. Now, I also think that Equitable Bank is going to not grow its shares outstanding over the next decade. They're actually buying back shares currently, and they're buying back about 3% of their shares over the next year is what the company wants to do. So 0% growth to the shares outstanding, I think, is also on the pessimistic end and being a little bit more conservative. Now, I also think that the stock is probably going to trade for a price to earnings ratio more around 9, but I want to be conservative again, so I'm going to say 7.5 over the next decade. And when I put in these metrics, I can see that Equitable Bank is still selling 6.5% below fair value. So I am going to knock down the growth rate to about 9.5%, and then we get very close to fair value of about $58.15. So this is basically right here what the market is projecting for Equitable Bank over the next decade. 9.5% growth to their earnings annually, no dilution, and a price ratio of 7.5. Now, if we scroll down, we can see that this means that Equitable Bank would be producing earnings of about $754 million by the end of 2032 on an annual basis. The company today is producing about $304 million in annual earnings, and honestly, I think that they're going to more than double this, and their growth is going to be pretty significant over the next decade. Honestly, I think that they're going to grow at 12% annually. I would not be surprised to see their price ratio expand to 9 to put them more in line with how other banks in the market trade. And I'm going to say that, they're going to buy back 1% of their shares annually. And when we do this, we get a fair value for the stock of $96.70, which is about 69% above where the stock is currently trading. So this is more in line with what I am personally expecting. And this tells me that there is quite a margin of safety when I am buying Equitable Bank stock. And if these projections come true, then I should receive a 16% compounded annual growth rate on this investment. Now, our discounted cash flow calculator does also not include dividends as of today. This is something that we are going to add in to our discounted cash flow calculator in the future, but right now, again, we do not have that information. And also, again, I said that I think Equitable Bank is going to grow its earnings at 12% annually. So if we scroll down, this means that by 2032, Equitable Bank could be producing about $946 million in annual earnings, which I think is realistic. I would not be surprised to see them even do $1 billion in earnings by 2032. So yeah, I am happy with these projections, and I am happy with the overall result here. Now, let's move on to another stock, which is Tesla. Tesla is currently crashing in the market. I don't know what Tesla is going to be doing by the time I post this video, but yeah, Tesla is freaking tanking right now. So let's do a discounted cash flow calculation on Tesla, and we are going to be tracking the company's free cash flow. Now, let's put in a growth rate of about 20% just to start off. Let's say that the company is not going to dilute, because I don't think that they're going to have to dilute. Let's put in a price ratio of about 30, which I do think is still kind of expensive, but we're just going to put it in anyways. So when we put in a 20% free cash flow growth rate, a 30 price ratio, and no dilution over the next decade, we get a fair value of $201 per share. So this is not what the market is currently pricing Tesla for. So let's knock down the price ratio to 25, and let's put in a growth rate of 16%, 16.5%. Okay, so over the next decade, this is what the market is currently pricing Tesla for: a 16.5% compounded annual growth rate to the free cash flow and a 25 price to free cash flow. Now let's scroll down, and this means that Tesla would have to produce about $41 billion in free cash flow by the year 2032 to meet the projections or meet what the market is currently pricing the stock at. Now, personally, I don't know if Tesla is going to produce $41 billion in free cash flow by 2032. I think that's more on the optimistic end. Listen, that's just me personally. So what I would like to do is maybe knock down this growth rate to about 15%, just knock it down a little bit. And when we scroll down, now this means that Tesla would have to produce about $36 billion in free cash flow by 2032, which I think is more realistic. And when I do this, I get a fair value of about $110 a share. So for me personally, this is where I would be more happy to be buying Tesla shares, is around $110. Because at that price, Tesla would have to have a price to free cash flow of 25, not dilute, and only grow at 15% over the next decade, which I do think that the company could potentially do. But basically, the higher the price that I am buying the stock, the more future growth expectations that I am pricing in. So I like to be a little bit conservative again, and this is kind of what I would expect for Tesla. All right, now the next and final stock that we're going to talk about is Magnet Forensics. This is a smaller cap growth company, and this company IPO'd not too long ago, so we do not have a lot of historical data on this business. But I am going to be projecting the company's free cash flows over the next decade, and I'm going to manually override everything here, and I'm going to show you why and how you can do this yourself. So again, this is a brand new stock in the market. We don't have a lot of data on it, and we can see that the most recent free cash flow number is about $15 million, and I think that this should actually be higher because the company has a 92% gross margin. And on other businesses with a 92% gross margin, they usually have about a 40% free cash flow margin. So I am going to override this most recent metric right here, which was the 15 million, and I'm going to put in about $30 million in free cash flow because I think this is what the company could be producing right now if it was not so heavily focused on growth and plowing all of their money into growth. So $30 million in free cash flow is honestly probably a little bit pessimistic as well. If this company wanted to, it could probably produce $40 million in free cash flow right now. But yeah, again, I'm just going to keep it a little bit more pessimistic. Now, also, I'm going to put a 25 price to free cash flow. I'm going to say that this company is going to dilute by 1% per year. And I think that the company could grow its free cash flow by 20% per year over the next decade because it's in the cybersecurity industry and it's growing its revenues at 40% plus annually right now. And the company said that they see potential for them to generate $1 billion in revenue, which is 10x what the company is currently producing over the next decade. So they basically think they're going to 10x the business over the next decade. And yeah, so let's check out what these numbers equate to. If we scroll down, this means that the company would have to produce about $185 million in future free cash flow by 2032. And honestly, I do think that this is on the more low end because remember, the company said that they think they can produce $1 billion in revenue by 2032. And I think that they can also have at least a 30% free cash flow margin on the conservative end. So basically, I think that the company could grow and produce about $300 million in annual free cash flow by 2032. So I played around with these numbers and I found that Magnet would essentially have to grow their free cash flow at 25.5% annually to produce about $300 million in free cash flow by 2032. And if we scroll down, we can see that right here with about $290.7 million produced. Now, if we take a look at the fair value, this means that the stock has a fair value of $84 a share, or about 130% above where the stock is currently trading. So basically what this means is that if Magnet can actually execute and 10x their revenue over the next decade and produce that 30% free cash flow margin, then the stock is massively undervalued right now, which is why I own it. I do think that it is a little bit more of a speculative stock in my portfolio right now. But with how quickly the company is growing and with its incredible gross margin, I am optimistic that this company will become a free cash flow machine in the future and continue growing over the next decade. So I think that there is actually a little bit of a margin of safety on this business just due to how quickly it's growing and its incredibly high margins that it has. So that's how I think about stocks that just hit the market and how I use the override metric to factor in what the stock could be producing right now if it were focused more on being lean instead of just growing as fast as possible and dumping all of their cash into growth. So yeah, that is the different ways that we can use our discounted cash flow calculator to see if a stock is currently undervalued or overvalued. And it all depends on what we expect the stock or the business to produce over the next decade. And then projecting that out and seeing if we can get a good return on our investment today. So that is kind of just like a discounted cash flow calculator tutorial. I hope that this all made sense, and I really hope that you guys enjoyed the video. If you did, as always, please remember to leave a like on it. And if you're new here, please subscribe to the channel to get more stock market related content like this. Also, if you are new here and you have not checked out Stock Unlock yet, then you can go and get a 14-day free trial, totally risk-free. You do not need a credit card or anything. You just need to put in your email, and then you can come and play around with our discounted cash flow calculator and all of our other features. Again, for totally free. I can guarantee you guys that if you use Stock Unlock for 2 weeks every day during your free trial, you will become a better investor. So seriously, go and get your 14-day free trial at stockunlock.com, enter in your email, get that, and let us know what you think. But that's going to wrap up the video for today, everyone. Thank you so much for watching. I truly do appreciate it, and I really hope to see you all again in our next video.